The markets, as we speak, are showing record highs for a number of different areas. Of course, we've seen record highs on the S&P 500. In fact, Wall Street indices, broadly speaking, are at very close to their near all-time records. We've got a number of major benchmarks across the European markets, France and Germany most notably, at record highs. And we've got multi-month highs here in London on the markets. And then outside of that, of course, we've got the really big headlines coming through with gold and Bitcoin. Let's now clear away some of the noise and take a look into more detail about what's been happening. Ron William joins us now from RW Advisory. When we spoke about getting this together, I was rather hoping we were going to be talking about gold. But in fact, gold is, as I said, joined by another of other areas of the market where we got these highs recently. Let's, as I say, clear some of the noise. And if we can, start off with gold and talk about it in terms of context. What are your thoughts?
Gold at record highs in dollar terms and also other currencies, as we had discussed and was predicted, according to my analysis last time. We're here now, overbought in the short term, so likely to get an unwind. And you can just see there just how far gold has surged away from its shortest moving average, the monthly 20-day.
Which is the blue one.
Which is the blue line, 2088, but also near psychological 2000 below, which is where the 200-day average. So you've got a zone there between 2100 and 2000, where we could get some healthy respite and a new buy on the dip opportunity. Useful to look at the chart that you just flagged up there on the platform with the MACD indicator on the lower panel, just showing that momentum is now tipping at a new historical threshold. I think if we compress the chart a little bit, we can see that coming in there from spring 2023 going into the prior year of 2022. We are verging on new momentum record breaking on the gold market. That is initially a mean reversion signal, but later on, once the market has a mini flush out, we're likely to resume much higher again.
As I said at the top, we're looking at a number of different markets where we're seeing a lot of enthusiasm buying. To some degree, I know that people don't know where to put their money at the moment. It's waiting for some clarity. Can you give us some more context about where we are with gold and Bitcoin and the equity markets?
Momentum. It's the momentum trade, broadly speaking, in terms of trade strategy, but also investor sentiment. But the macro factors are somewhat dispersed, particularly when you look at it from a global macro mix, which is what this ranking model does. We featured this in prior discussions. It's a key part of the process at RW Advisory. Essentially, we're looking at long-term, medium-term, short-term, strategic, tactical, and active. And the ones I've highlighted in the black box is basically what's moving and at record highs. So you can see there Bitcoin and gold, and then in terms of commodities and digital. But if we then look at the equity market, Japan, of course, is not just at record highs, but record highs since its 1989 bubble peak. So that's even more of a headline point. But all at the same time, which is unusual. So a little bit of risk on and off dispersed rotation, which shows there's a momentum trade in play, but also a potential rotation in this late stage cycle phase, which remains, according to my work. The charts on the top right just show figure 2. Gold in relative terms remains elevated ever since, well, year to date, and also since October last year. And just down below on the right, risk proxy is tactically overbought. So copper's in there along with some of the equity markets, just giving you an idea as to how there is still due an unwind in the next few weeks and months within this risk on phase.
Yeah. Talk to us a little bit about some of the macro features on the markets. So you've got here behavior inflection points ahead. What are you looking at here in terms of some of the background macroeconomic features?
Well, the big feature of our work at RW Advisory is the blended approach, top-down blended approach, macro, fundamental, and technical. We lead with the technical, but we do triangulate with each of those key factors, particularly when they coincide and start to produce some kind of a natural rotation. What's interesting from a behavioral point of view, and this is our big call for 2024, is that we are at a behavioral inflection point where the market and the so-called crowd wisdom could be on the wrong side of expectations, of reality. And what was the case, of course, of last year, a very strong market performance across the board, all looking for a new encore in 2024, particularly after central banks had promised, or at least perceived to promise, a cut in an inflation unwind in order to ensure that we could have a soft landing. And so this is a soft landing consensus indicator in the big main chart showing that we're at record extremes. So that just shows the whole market's on the same line for a soft landing. But then take yourself back to last year. Recession was one of the #1 predictions across the board. In fact, I remember there was a local financial platform that had a model predicting 100% likelihood of recession, and many financial institutions also echoing that view. Now, it didn't happen. And so in the end, we flipped from that prediction to no recession or to soft landing. What's interesting, and this has happened 3 times now. So we're at a record extreme now, and it's 3 times, and it could be the 3rd strike and out if indeed this turns out to be a pain trade to come. Part of the trigger for it, and this is just a plausible scenario that I'm illustrating here, is likely inflation. So one of the reasons why soft landing became a revived theory is because the economic growth has been robust, and then ultimately didn't work out last year. So it made sense to reassess and have a stronger view for the market. Figure 2, top right, highlights the fact that we've discussed before, that we could have a historical analog akin to the 1970s, where it's rolling waves of inflation volatility in which right here and now, yes, we have lows for inflation in place, but ahead of a resurgence to follow, likely second half of this year going into 2025. Now, this is a scenario, it might not happen, but there are increasing probabilities showing that it may, even in the numbers that have come out just this week and last month, hotter than expected and stickier, as is now being reported. This is the early stage signs of headline inflation coming back, but we may get structural inflation from from general overhang, but also from event shocks. And that's the last chart I'm just highlighting there, figure 3 in the bottom right-hand corner. What we call crisis alpha, the so-called black swan events. And the big underlying story that we all know is that geopolitical uncertainty remains. And according to a client survey by Goldman Sachs, 54% of their base certainly sees this as a top-of-mind concern for threats in the market for this year. Second, I believe, to that is US elections in November, then inflation, and then recession. But interestingly, I mean, each of these could cascade at any point in time. You just need one to trigger. So certainly worth considering these risk scenarios, especially when we're all too bullish, all in one particular trade.
Yeah. So the message is that there is a risk out there, and it's a growing risk. It's just a question of where that risk develops.
Yes, and preparation is key. I mean, even if the markets continue higher, preparation is half the game won, and certainly getting caught out and being blindsided is certainly a precarious place that I wouldn't want clients or viewers to be in.
Yeah. Just going back to what you were saying at the top about the blended market approach, looking at things, I can't help but think there's an interesting story to be told here between gold and Bitcoin. Not even between, but they seem to be running along the same sort of tracks now. Is that a misunderstanding on my part, or is that something that really is coming about?
In terms of record highs, yes. In terms of momentum trade, yes. And also in terms of even the behavioral pattern, also a third yes. Where they differ, of course, is gold tends to be more of a safe haven proxy, interest rate sensitive at times, not always. And I think recently it's been more of a gold standalone transformation phase where it's even dislocated from rates at times and not just outperformed in dollar terms, but also broad other currencies, which I'll speak on in a moment. So gold is traditional safe haven trade with its traditional macro correlations. Bitcoin, in this case, of course, is a hybrid asset class, as always, but in the sense of what drives it, it tends to be a mix of risk on and risk off. Currently, we could be seeing a little bit of both, but also the underlying drivers behind Bitcoin this year is, as everyone knows, the ETF launch just passed, which was big news for the big institutions, and also the halving cycle ahead is all bullish drivers for Bitcoin. Combine the two, gold and Bitcoin, you have a momentum trade at record highs, in addition to equity markets such as Japan and others. And for those looking to make money out of this and maybe leverage the trade, but in a safe way, there are vehicles such as one called the Bold Index, B for Bitcoin and the rest for gold, which can outperform and diversify by having an asset allocation mix of the two, roughly 80-20 based on a volatility calculation. It's developed by an industry colleague, Charlie Morris, who's CIO at ByteTree. This is an index and an ETF, and you can see there it's a double win when both are going up at record highs, but also just in case you get a crypto winter or a gold market going sideways, you do have that diversification protection in play.
So let's talk about some price targets. You're talking about the potential for downside, then a regrouping and a possible upside. Let's talk about some of your thoughts on where the market is likely to go.
Yes, so on gold, currently overbought and likely to have a short-term unwind into either 2080, which is that 20-day average, or an overshoot into the 2000 prior glass ceiling, which we tested multiple times. You can see there on the chart over the last few years. So it is an attractive area for the market. Either way, so long as we hold above that, it's blue skies territory for gold. The targets will be back above the recent high into 2,400, a technical target, and 2,700, which is an inflation-adjusted peak from the 1980 area. Which I have there in a chart in the bottom right-hand corner, just showing that not only has gold been there, but it can spike $700 in a short space of time if there's an event risk that leads it to do that. Just a quick point there, gold does react to either crisis in the market, whether it's kind of Silicon Valley Bank panic of spring last year, or geopolitical in terms of the Israeli-Hamas war still going. In fact, it's just kicked off again. But that was in October, and you can see that's when you had those shock impulses on gold. Here and now, it could also be a rotation defensive play, and that momentum trade that I alluded to. And then just finally, keep in mind that gold is also big picture a debasement trade, given that we have this long-term structural inflation overhang. Money is losing its value day by day, and so gold is increasingly being perceived as a safe place to go and a hedge. And that's why in the top right-hand corner, figure 2, you see gold priced in world currencies, not just dollar, but world currencies at all-time highs. And I believe if you look at 6 of the big fiat currencies, it's the same picture.
Interestingly enough, one of the, or some of the headlines we've seen recently have been really contrarian to what markets are happening. There's been lots of question marks about how far up these markets can go. And I think your last chart is interesting because you highlight a couple of the magazine covers that we've been talking a lot about recently, most notably The Economist here in the UK, but Barron's as well. Talk us through what's happening, where we are in the major cycle.
Yes, so late stage, which is why I'm going back to some historical analogs, which popped and then crashed in some way, shape or form, typically in a 3-stage pattern, a fall, oversold rally, then the rest of the fall. That's the way that we model these moves in markets, especially if they're an order of high magnitude. Then they fall hard. The stronger the trend, but they do it in stages. Now, the one that I've alluded to is the party of 1999, which is still telling us to enjoy the music until it stops. And we could be in that, that stoppage point any week now, going into Q2, basically, according to tactical cycles that I'm watching very keenly. In fact, it just recently triggered a week ago on the big down reversal on Nvidia, and I was quite surprised to also see headline covers on, as you mentioned, The Economist and Business Week, and this can be for any mainstream publication. This has been what is termed magazine cover indicator, usually contrarian, developed by an analyst decades ago, Paul Montgomery, but also featured in many of the financial institutions. Academia has done some research on it. Not a holy grail, but it's based on the theory that by the time it makes it to the mainstream press, where you actually have to print the headline, because that's such a long process anyway, at that stage, the hot topic becomes cold, and usually at the wrong side of the market move. So the fact that we have two magazines, not one, I think makes it even stronger. And the fact that that also happened just on the reversal of Nvidia, I think just makes it even more timely. We also have some bears that are now flipping to bull. I won't name names, but that also adds to the potency of this contrarian signal, if indeed it plays. And then just lastly, the obvious point that part of the reason we're all feeling bullish is because of that strong momentum. The trend is still our friends, and until it becomes an enemy at some point in time, as market cycles demonstrate. And you can see the top right corner, figure 2, momentum is thriving year to date in the trajectory of the 1999 peak. But remember, whenever we get that type of an acceleration up, it's unsustainable in the short term, and it is followed by a momentum crash, which at some point is healthy and inevitable. We've just delayed it for some time. And right now the cycles, if you look at the last diagram, it's the cycle timing model developed by the Foundation for the Study of Cycles, where I'm part of the team, that has for some time now been predicting further downside risk. We haven't seen it yet because there's a price and time divergence, but if and when that does realign, that's the alert that I'm bringing to you today with IG, just so your audience members can be aware.
Yeah, just wanted to talk very briefly about technically, as a technical analyst, we look at individual candle structures and so forth, and we try and anticipate highs. It's very difficult to anticipate a market in any way, shape or form. But just explain this idea about exhaustion, about the final thrust, if you like, on the upside, because there are some technical indicators to watch, aren't there, in terms of candle patterns. And as you say, the momentum indicators are really good. Overbought, the various sort of indicators that give us this sort of rise. But there are patterns to follow, aren't there?
Yes, absolutely. And I'm a big believer in pattern recognition. We all have the innate ability to do it. It just takes practice. Use it or lose it, as I like to say. And certainly chart reading allows us to enhance that ability. Tops are hard to pick, tops and bottoms, the tops in particular, because they tend to skew. And from market to market, they behave differently. So in equity markets, we typically look for a blow-off top. It's that irrational exuberance or melt up that races higher and then ultimately falls into a vacuum where the last buyer has bought, greater fourth theory, then you get the downdraft that follows. Often you will see, I mean, V-shaped tops, just as you get V-shaped bottoms, which can show that. Either way, you need to wait for a confirmation to the downside to really have that safety margin in place. This would be a good time, if viewers are concerned about this, to at least trim or look for protective stops, or maybe hedge as a peace of mind strategy. The other thing is sometimes you get gaps in the market, exhaustion gaps, island reversals, candlesticks. There's lots, but evening star patterns and all kinds of different terminology, which I won't dive into. But essentially, these are exhaustion moves that you can get not just on the price chart, but on the actual session itself, which is why a combination of all of the above can be useful.
This is what I find fascinating about this subject. We could go on for a long while, Ron, but we've got to leave it there. But thanks indeed for joining us.
Thank you so much.
It's a pleasure. Ron William from RW Advisory. If you want to catch up more with Ron on his website or indeed on his LinkedIn page, and he'd be more than happy to answer any questions, I'm sure, about some of the TA around what we've been talking about today and this pattern that's now beginning to develop, interestingly, for a number of different markets. That's Ron William from RW Advisory.